What's up, everyone? I opened a trade today in XOP, which is an oil and gas ETF. I sold the 9568 Strangle for the 18th of June expiration, which is 52 days away, and I collected $2.14. Heading over to the trade tab, the June 18th window here is right in kind of the sweet spot. 45 days is kind of considered the sweet spot, and it's approaching there at 52 days. I personally really like the 40 to 50 day window, and we're basically there. So assuming I have capital to use, I am looking to open trades more often in this 40 to 50 day window. I trade XOP on the regular basis, and as you can see, I have one going for the earlier May expiration cycle. That's a Strangle there too. But for this one, I obviously picked the 52 day window, and then I sold the 68 put, and then if you come down here, I sold the 95 call, and those two together, I collected 214. Right now it's saying 213 is the midpoint, and those two together make up the Strangle, and I just want the range of the price action to stay in between these, right? And I'm a little bit bullish on this. You'll see here when I show you the chart. So I skewed this to the upside a little bit. You know, this is at the 18 delta. Usually on Strangles, I try to get both legs at like the 15 or even 10 deltas. And then that'll collect, you know, somewhere near $2 typically. You know, obviously there's wiggle room there. Sometimes it's only like 180 or maybe it'll be 220. So anyways, this time I skewed it to the upside a little bit. So the 68 put here is at the 18 delta. And then down here, I'm only at the 13 delta. So I'm farther out of the money for the 95 call. And as you can see, this only collects, you know, about 70 cents. And then this one is collecting about, you know, $1.40, $1.45, something like that. So it's skewed to the upside. Again, when I show you a chart here, I'll show you why. But essentially, when I'm opening Strangles or even selling just naked puts or naked calls, I'm always looking around this dashed line here, which is the one standard deviation. So this one's down here, and then the put side is up here. But then also, if you want to see, the Tastyworks platform gives you an estimate here, right, for the IV for this cycle. I actually don't know exactly what the IVX is representing, but for this time frame, it's estimating there's going to be a $9.46 price movement, and that movement is assumed in either direction. So right now, so the current price here is around 78 bucks. And if you take that $9.37 estimation, if you follow this orange bar here, that is what they are considering the expected move for this time frame. So a little over $9 from 78 puts you down here at the 69 strike on the put side. And then if you follow that orange bar, it puts you up here around the 88 strike. So in theory, if you just sold those strikes right outside the orange, in theory, you were putting yourself in the position of where the IV and all of the calculations under there think this price action will move in the next 52 days. And if you see here, I can bump it up here, and that usually puts you right around that 68 or 66%. And sure enough, right there it is, 66. So anyways, I want to be a little more conservative, especially on the call sides. I don't really like messing with those. I mean, even though a loss is a loss, whether it's a call or a put. Again, I think this is slightly bullish skewed, so I went much farther out of the money there than the 88. I went with the 95, and I got 214. So then that leaves me with a 72% pop, 85% P50. My max profit is 214, but I take profits, especially with Strangles, I take it more like 50% or even sometimes a little bit under. I don't try to push my luck with them. My max loss is infinite or undefined because in theory, if it goes up the call side and breaches that, technically, in theory, you can lose money forever if it just goes to like $1,000, right? And then even on the put side, you know, your loss is unknown. It's unlikely to go to zero, which you would then lose, you know, $6,800. But you know, if it goes down to $50, you don't know how much you're going to lose, right? So you could lose $100 or you could lose $2,000. So it's undefined or unknown. They use the infinity sign. And then buying power for this is nice and low, all things considered. You know, I'm collecting over $2 and the buying power effect is only like 783. So that's great. That's a great return on capital. And I guess one final note here is that the strangles are undefined risk trades, which I kind of talked about already. And if you want to define your risk so you don't have this unlimited max loss, you can buy a call that's farther out of the money here, and you can buy a put that is farther out of the money there. And that will protect you on the upside and the downside. However, that will lower your pop, but it locks in your max loss and it lowers your buying power effect, assuming you're doing, you know, like a 5-point wide spread on each side. So anyways, I'm not going to go through that because I don't really trade that. I almost exclusively trade the naked premium trades of strangles and naked puts and naked calls, because even though they require more buying power, your probability of profit is actually higher, and sometimes it's much higher. And then also, in my opinion, they are easier to manage. So if something goes against you, it's just one leg of a trade, right? Instead of two. So if you want to roll it or take a loss or take a winner or whatever, you know, it's just easier to manage. It's just one leg instead of 2 or 3 or 4 or whatever. So, all right, I've talked Tastyworks to death. Let's look at the chart and see what the technical analysis is looking like on this trade. All right, so here's XOP's chart, and this vertical line here is today, and I opened the trade today, obviously, and I sold the 95.68 strangle, which is 95 is way up here, and that's above the most recent high here, which is a good thing because that's kind of a natural line of resistance typically. And then the strangle is down here at the 68 mark, which that's around this region, which had a lot of kind of resistance and support. So that's good too. And then also the long-term 200 moving average lines right up with that 68 strike right now. And so that's another line of resistance in theory. So by the end of the day, I just want the price action to stay right in this range here, right? Basically right in the middle. And I think it's headed higher, at least in the short term, for a little while because of the Ellie wave. So had this ABC correction down here, and then you got 1 up, 2 down, and then you went 3 up here, and then another ABC correction. And then in theory, it's gonna start heading higher again, eventually coming potentially all the way up to like 105-ish range. Obviously, I am banking on that not happening within the next 52 days. With that being said, that is why I skewed it higher to the call side, right? It's farther out of the money at the 95 strike than it is at the 68 strike. And then also, it seems like it's about to turn the corner higher because of the MACD is starting to turn positive here when it's below the 0 line. And then RSI has, you know, essentially bottomed out here and it's kind of heading up. However, with that being said, this could still be completing its correction down just a little bit closer to this 200-day moving average, which would be right at the 68 strike. So all things considered, I think this ultimately will drift higher. However, based on the deltas and the IV rank and all that jazz, in theory, these strikes are much farther out of the money than the expected move in the next 52 days. I guess the last thing to wrap things up here, strangles usually last about 2 to 3 weeks, so 14 to 21 days. So that's what I'm expecting to happen here. As always, I will keep you posted and I will let you know how this trade plays out. All right, I think that's it. Thanks for tuning in. I'll see you in the next video.